Let me walk you through how venture capitalists actually evaluate startups when deciding whether to invest or not. It's not just about having a good idea, it's about the whole picture: team, timing, traction, and how big the potential really is. Valuating a startup is a mix of art and math. So, first off, VCs bet on people more than anything, and people are like a roller coaster. You could have the greatest product in the world, but if the team behind it isn't strong, coachable, and resilient, it's a no-go. VCs are looking for founders who know their market, can adapt fast, and have that crazy mix of vision, charisma, and execution. VCs are looking for startups that can scale in huge markets, not just niche ones. They want billion-dollar opportunities. But a big market alone isn't enough. You also need to show traction, some real signs of progress like users, revenue, or partnerships. And finally, your product or tech has to stand out. It needs to be unique, hard to copy, and ideally positioned to win in a competitive space. And let's not forget timing. Even a great idea can flop if the world isn't ready for it, or if you're too late. Timing is this weird mix of intuition and data. Is the infrastructure there? Is behavior changing? VCs think about this a lot. Now, when it comes to valuation, it's honestly a mix of art and science. They'll look at your revenue, if you have any, the market, comparables, and risk. But ultimately, it's about what return they could get if you exit, whether that's an IPO or an acquisition. They're asking, if I invest $1 million now, can this turn into $10 million in 5 to 7 years? In the end, it's a combination of gut feeling and pattern recognition backed by numbers and logic. They've seen hundreds, even thousands of startups, so they're always comparing, asking, does this feel like a winner? That's what it comes down to. Be creative, stand out, and remember, VCs don't invest in ideas, they invest in momentum, markets, and the magic that only you can bring to the table.